We're going to go right into our final talk of the day, and that's by Rodgin Cohen of Sullivan Cromwell. Raj, as you know and have heard, was everywhere, maybe representing everyone during the financial crisis. When most people think about the lawyer's perspective on the financial crisis, they think about Raj. He's the lawyer who appeared on camera, has been portrayed in the film Too Big to Fail, and mentioned in innumerable articles and books. And all of that is for good reason. He had a hand in it all. The brief bio in the agenda highlights this well. I won't cut into his time further, so Raj, would you please come up and share your thoughts with us?
Thank you, Lisa, and good afternoon. As the last presenter at this extraordinary conference today, what I'd like to do is focus on the future as informed by the lessons of the financial crisis, less about what was done right or wrong during the crisis, and more about what we need to do to prevent or at least mitigate future crises. And I'm going to offer 11 observations which will include echoes of a number of points made already today. The first observation is the need for recognition by our policymakers, regulators, the media, and the public that financial crises are, by their very nature, largely unpredictable. This is not a matter of humility, but of reality. If it were otherwise, would be far less likely to ever be a crisis because it could prevent it if you could foresee it. But as history has taught us, financial crises will occur. Second, and relatedly, it is essential not to be either resigned or complacent about future financial crises. The reality that prediction of a financial crisis is often impossible does not mean that we should refrain from endeavoring to identify the most likely sources of a crisis, attempt to minimize the risks that a crisis of that nature will actually occur, or fail to lay down the necessary foam on the runway to minimize the impact. As I will discuss in a few moments, we have done much both to prevent and deal with another financial crisis, but I don't think there can ever be enough, and circumstances change. In summary, we should not be placing crisis planning on the back burner because there is nothing we can do about it or because we have done enough already. My third observation, and this has been repeated a number of times, is the need for the major government entities that deal with financial institutions to be led by individuals with courage, integrity, and judgment. Individuals whose objective is to do what is right for the country without regard to politics or personal advancement. They must also be strong communicators, and they must have the ability to attract and retain the best possible staff. In my view, the real unsung heroes of the 2008 crisis were the staffs at the Treasury and the bank regulatory authorities. I said 10 years ago, and I've never wavered in my belief, that the agency leadership in 2008 was the principal reason we were able to avoid the crisis becoming a cataclysm. Those individuals had the capacity to recognize the desperate nature of the situation and the fortitude to take the actions that were required. This is not to say they were perfect in their decision-making. Perfection is, of course, not the human condition, but they made the decisions that great leaders make. Now, the media has rightly focused on Treasury Secretary Paulson, Fed Chairman Bernanke, and New York Reserve Bank President Geithner. But we should not overlook the major contributions of the FDIC Chair Sheila Bair and of the Comptroller of the Currency, John Dugan. These are the 5 positions, and I would today certainly add the SEC, that any administration must strive to fill with the most qualified, skilled, and committed individuals. All the structure in the world, regulatory and otherwise, will be insufficient if we don't have the right people to implement that structure. My fourth observation relates to the concern that regulatory arbitrage could lead us to a future financial crisis. Now, regulatory arbitrage is usually conceived of in terms of selecting between two safety and soundness regulators, for example, between the OCC and the FDIC, or state and federal regulators, or in the day, a bank charter or a thrift charter. I would suggest, however, that this is not the principal regulatory issue when we are considering the potential of a financial crisis. Instead, the principal regulatory arbitrage issue involves the alternatives of being subject to a safety and soundness regulator or not being subject to such a regulator. The analysis for a number of financial institutions then and now is how competitive can we be in offering financial services without incurring the costs and burden of regulation. The 2008 financial crisis was precipitated, as has been discussed, by an unprecedented decline in the mortgage market. It should be recognized that many of the basic elements of the decline were hatched and incubated by a group of mortgage banks that were not subject to safety and soundness regulation and were facilitated by other institutions that were not regulated or only minimally regulated for safety and soundness. Now, safety and soundness regulations should be limited. They should not be so broadly applied as to stifle innovation without a clearly defined need. But it is a fundamental flaw not to have safety and soundness regulation for institutions or groups of institutions where the need for such regulation is demonstrated by the potential for systemic risk. I'm making this observation not as a competitive issue, but as a systemic risk issue. Now, my fifth observation involves a need for flexibility for dealing with financial crises and Congress's inexplicable decision in Dodd-Frank to remove some of that flexibility. And that was to take the statutory basis away for a number of actions that the Federal Reserve and FDIC took to support the financial system during the crisis. As a result, these regulatory actions and perhaps innovative actions of the future will no longer be possible. Now, I have consciously used the word inexplicably to describe the congressional action. If you think about it, the stated reason for the statutory amendment was to prevent future bank bailouts and too big to fail. But is this analysis really legitimate? As I noted earlier, because a crisis is unforeseeable, the government agencies responsible for dealing with it require as much flexibility as possible. And it is, in my view, inexplicable that this flexibility would be reduced in any meaningful way. Moreover, the better way to deal with the issue of bank bailouts and too big to fail is what Congress and the regulators have actually done elsewhere, including in Dodd-Frank. Now, even if you consider that in isolation, the elimination of Fed and FDIC flexibility could actually advance the goal of ending too big to fail, at this point, such an amendment is largely superfluous. Title II of Dodd-Frank, as has been discussed, makes clear that in the event of a bank's resolution, shareholders must be wiped out, management replaced, and creditors absorb all the losses. This is the very definition of failure. Moreover, as Randy mentioned, Federal Reserve regulatory policy now requires the major banking organizations to maintain substantial TLAC over and above regulatory capital requirements, and this TLAC requirement assures there is very substantial creditor cushion to absorb losses. My sixth recommendation, or actually observation, relates to what I believe may be a serious misperception arising from the financial crisis. It is often said that a principal cause of the crisis was interconnectedness, that if one institution failed, it would cause other failures because of the indebtedness of the first institution to the others. There is, however, limited evidence to support such a hypothesis and direct evidence to the contrary. Interconnectedness was purportedly one of the government's reasons for supporting AIG, but I have not seen credible evidence that any other institution would actually have failed because of its exposure to AIG if AIG itself had failed. Moreover, when Lehman did fail, the only institution that Lehman took down with it was the reserve fund, and even there, shareholders got back 99 cents on the dollar, and by taking another institution down because of exposure to Lehman. There was, however, in fact, a relationship between the failure of any one financial institution and pressure on other institutions. This was a matter of contagion, a term that Lee correctly used several times rather than interconnectedness. Contagion begins with a concern by security holders and creditors that the problem at one financially distressed institution are replicated at other institutions. Either because this replication concern cannot be diffused or there is insufficient time to diffuse it, the creditors and security holders simply run from all similarly situated institutions. This is contagion, and it is what actually occurred during the days and nights following Lehman. Now, this distinction between interconnectedness and contagion is not an academic exercise. If we don't understand what the problem is, then we can't effectuate the solution. A large part of the answer to contagion is not only the existence of, but the ability to demonstrate strong capital and liquidity. But the answer also requires sufficient transparency into all material aspects of an institution's business so that creditors and security holders can have more confidence that the problems at one institution are not replicated elsewhere. And I believe there is more that can be done in the area of transparency. Furthermore, the antidote to interconnectedness may create its own significant problems. That antidote is to minimize financial relationships among major financial institutions. But particularly in times of stress, a financial institution's ability to obtain funding and liquidity quickly and quietly can be essential, and only other financial institutions may be able to meet this need. A loss of access to other financial institutions may actually precipitate rather than confine a financial crisis. My seventh observation is that, as a number of speakers have already indicated, is we must maintain the basic building blocks of bank safety and soundness, strong capital, strong liquidity, and the stress testing and overall risk management to ensure that under a dynamic evaluation, nominal regulatory capital and liquidity ratios are consistent with the actual underlying risk. These attributes are essential for multiple reasons. They reduce the likelihood of failure of any individual institution, the impact of any failure on the institution's creditors, and the potential for contagion within the system. Now, this is not to say that more capital and more liquidity are always better. It is a matter of mathematical inevitability that at some point more capital and more liquidity mean less lending. Nor is this to say that all aspects of the current regulatory capital and liquidity regimes are unquestionable. There are undoubtedly changes that could be made, but any meaningful reduction in the current capital and liquidity requirements or their support system should be approached under a preponderance of the evidence standard. My eighth observation relates to Title II of Dodd-Frank. As has been mentioned, the so-called Orderly Liquidation Authority and its companion, resolution planning. They are essential to reducing the systemic impact of the failure of a financial institution. Moreover, I actually believe that the existence of Title II and resolution planning reduces the risk of failure in the first place. Creditors can have more confidence that they are not confronting a prisoner's dilemma and must flee at the first whiff of a financial institution's difficulty. Fortunately, we have avoided a legislative response to the calls by some legislators and academics for repeal of Title II. But the intensity of the opposition means that I'm not sure this is the final chapter has been written. So I want to take just a moment to try to respond to the three principal arguments that have been articulated against Title II. First, it is argued that Title II codifies too big to fail. I'm frankly puzzled by this because, as I just mentioned, Title II requires failure by its impact on all the relevant constituencies. And it is noticeable that after Title II was in place and its structure better developed, that the rating agencies then reversed their previous rating uplift for the potential of government support. The second argument, which I find the most incredible of all, is that Title II represents an anomaly. In the statement is made, well, everybody else is resolved under the bankruptcy code. Not true. It's virtually all other financial institutions, banks, insurers, and broker-dealers are resolved under a special regime in recognition of their special attributes and needs. Third, it is argued that Title II creates the potential for taxpayer exposure, but even the Congressional Budget Office, which has scored Title II negatively, acknowledged that the risk of taxpayer loss is, quote, remote, unquote. Indeed, Title II is carefully constructed to insulate the taxpayer. My ninth observation relates to what I regard as the most likely source of a new financial crisis. I'm in full agreement with Gary. If you have to pick one, it's a major cyber attack because it can be against an individual bank. It doesn't need to be the largest bank. If it creates a confidence problem, it can be a group of banks simultaneously, or what perhaps worries me the most, one of the utilities that serves the financial services industry. Virtually every bank takes the risk of a cyber attack very seriously, has spent a ton of money on the issue, and there has been a willingness among the banks to act on a concerted basis to share information and strengthen their defenses. I'm less certain, however, about the efforts of the financial utilities, particularly those that are not Title VIII FMUs. And my greatest concern is about the interaction between the government and the banking industry. A lot of talk today correctly about the value of public-private partnership. I think we need to go a lot further on cyber. The government has to be more willing than it is today to share. My 10th observation, which is a particularly strongly held view on by me, is that there is a risk in the current push for regulatory and financial ring fencing on a jurisdictional basis that could exacerbate and even accelerate a financial crisis. Now, what I'm talking about here is a legislative or regulatory determination that the assets, liquidity, or governance of a banking operation or its capital could be captured and must be captured within the rules and regulations of the jurisdiction in which that operation is located, the so-called host country. What is in effect the superimposition of a national structure on a global banking system? There are a number of examples. The first is the Federal Reserve's decision to impose an intermediate holding company requirement on foreign banks with $50 billion or more in U.S. assets. There's the EC's intermediate holding company proposal, and there's the ECB's advocacy for a subsidiarization approach by eliminating branching into the European Union. But my most significant ring fencing concern is none of these. It relates to high internal TLAC requirements. If capital or liquidity is trapped in one part of a global institution, irrespective of the actual need for it, the flexibility to deal with a crisis in any affiliated entity is curtailed. And we're dealing with human nature. And a time of great uncertainty, will any regulator or government be sufficiently confident of the financial status of the entity in its jurisdiction that it will make the hard decision that there is excess capital or liquidity that can be safely transferred to another jurisdiction? Now, the unpredictability of a severe financial problem means that if one occurs, it is likely that notwithstanding all the capital and all the internal TLAC, that there will not be enough. And not enough either to restore that subsidiary to financial health or enable an orderly wind down. In a ring-fence world, the local institution then cannot anticipate any support from its affiliates because they are going to have their own ring-fence regimes. Indeed, as I've indicated, this form of ring fencing may actually precipitate a failure because the funding and other markets will recognize that ring fencing prevents or at least discourages or severely limits a global group from providing assistance to a troubled affiliate in a foreign jurisdiction. Not only will the affiliate be more likely to collapse when confronting financial difficulty, but there is increasing danger of contagion both with respect to other affiliates and other financial institutions in the same country. Now, it is theoretically possible, but not inevitable, that if one country were to ring fence and no one else does, that country will benefit in a financial crisis. But that's not reality. If several jurisdictions ring fence, all must. And if all jurisdictions ring fence, there is a substantially heightened risk that everyone loses. And my 11th and last observation, I got to 11 rather than a normal number like 10 because I was listening to some of the comments made today, so I've added this. And it relates to the one inevitable outcome of any financial crisis, and that is that the reputation of the banking industry will be badly damaged. I realize that it can be difficult for banks to think about long-term reputational issues when their very financial survival may be in question. But absent that foresight, the legislative and regulatory response will not only be harsher in the immediate aftermath, but for years to come. And even more importantly, public mistrust may be generational. So if we have a few minutes, I'd be glad to take, we don't have a lot of time, questions, but I would like to close by expressing my appreciation to Lisa for her vision and her inspiration for this conference.
Questions for Rob? Questions? Well, I have one. Do you keep a diary?
No.
Well, I've heard you speak several times now, and I've always been wanting to hear you read your diary from September of 2008.
That's why I don't keep one.
Did you sleep at all that month?
I think I was sort of in the several hours a night capacity most nights. There were a few, but there was none.
Anybody got a question over here?
With respect to the cyber threat that you mentioned, can you say a little bit more about what you're thinking in terms of a more robust partnership between the private sector and the government, and what the government might share?
Okay. So in trying to figure out what happens in cyber, frankly, the first problem is the government has to get its own act together. The idea that literally we have at least 12 major agencies, each with responsibility for a piece of cyber, is just going to precipitate a cyber attack. It's going to make it more vulnerable. So that's going to have to be part of it. But in the second phase, how they then share, first of all, you have an agency you know to go to. Today, and I think you've seen this in some of the cyber attacks, you don't even know where to go to. Is it your bank regulator? Is it the Secret Service? Is it Treasury? Is it DHS? By just having a single point of contact, which has the information, it's going to be much advanced. But then I think the government needs to do more to be telling the industry where it sees the risks coming from and enable the industry to prepare. Now, there have been a lot of rumors floating around the last 2 weeks about what the government has been telling the industry, and I would say those rumors do not represent the need, really represent what should be done here.
Alfred Pollard, FHFA. So a lot in this meeting hasn't addressed one issue, which is fraud. There was an enormous amount of fraud during the crisis, but one thing you mentioned briefly that I asked you to touch on, we talk about too big to fail in large institutions. You briefly skimmed over small. I go back, since I'm ancient, to Penn Square, Hammersmith and Fulham. I think Mr. Pickle will respond that he remembers that froze up the swaps market. What's your thought on that, just that we keep talking about big institutions? And you did mention it lightly, Rodgin. Is there anything in the small or non-bank servicers, all these people?
Sure. So let me actually, Alfred, you make a really good point on fraud. So, and it leads to where I first saw there was a problem, or I thought I saw there was a problem. There's a group called BSAG, Bank Secrecy Act Advisory Group, and they meet ever so often at Treasury. And I remember the meeting, and where this was in late 2006, and you went in there and they showed aggregate SAR filings, and they were going up sort of a normal trend. And then they broke it down, and mortgage fraud was like this, almost perpendicular. And, you know, this was already 2004 or 5 data. I mean, it was dated. So fraud did play a role. And look, small banks can create a problem. There is no doubt about it. But nobody thought we were on the verge of financial collapse because of the numerous thrifts that failed in the 80s. Penn Square was an anomaly, I think, because Continental had a ton of exposure to Penn Square, and even less than that, they were the happy recipient of all the participations in the Penn Square loans. So you can have a small bank that can wreak havoc, just as some of these mortgage banks were able to wreak havoc. So it's a very well worth point. I mean, you can't just look at the very largest.
Thanking again Raj and all the other panelists we had today.